Gold just did something that hasn't happened in the 5,000-year history of this precious metal. On January 27th, 2026, gold prices exploded past $5,110 per ounce, shattering the psychological $5,000 barrier that experts thought would take years to breach. But here's what nobody's talking about. This isn't just another rally. This is a 70% gain in just 12 months. That's faster than the S&P 500, faster than tech stocks, even faster than most cryptocurrencies. And the shocking part, every major institution, from Goldman Sachs to the central banks of Poland, China, and Brazil, is predicting this is just the beginning. In the next 15 minutes, I'm going to show you exactly why gold could hit $5,800 by the end of 2026, who's panic buying right now, and the three massive catalysts that could send prices even higher. But first, you need to understand what's really happening behind the scenes, because what I'm about to reveal will change how you think about money forever. Stay with me. This is urgent. Let's start with the numbers that should terrify every investor holding cash or bonds right now. Gold has surged 20% year to date in just 4 weeks. 4 weeks. That's the kind of move that typically takes 12 to 18 months, but we're living in anything but typical times. As I'm recording this on January 28th, 2026, gold is trading in the $5,074 to $5,234 range, and it's holding these levels with conviction. This isn't speculative froth. This isn't retail investors chasing a trend. This is something far more serious. Here's what you need to understand. Gold has outperformed virtually every major asset class over the past year. While traditional portfolios struggled with volatility, gold delivered consistent, powerful returns, and the institutions managing trillions of dollars have taken notice. But to understand where we're going, we need to understand the three forces creating what analysts are calling the perfect storm for precious metals. And believe me, when you see these factors converging, you'll understand why some experts are predicting gold could reach $6,000 or higher if certain scenarios play out. Catalyst number 1, Trump's tariff wars, 235s. The first catalyst is unprecedented, and it's happening right now. President Trump has launched the most aggressive trade war since the 1930s. And I'm not exaggerating. Economists are literally comparing this to the Smoot-Hawley Tariff Act that helped trigger the Great Depression. Here's what's happening. Trump is threatening 10% tariffs on 8 European nations over Greenland. Denmark, Germany, France, Italy, Spain, the Netherlands, Belgium, and Sweden are all in the crosshairs. And get this. He's warned these tariffs could escalate to 25% by June 2026. But it gets worse. Canada, our largest trading partner, is facing 100% tariffs. 100%. That means doubling the price of Canadian goods. Why? Because Ottawa might pursue trade deals with China. Think about that for a second. We're threatening to economically destroy our closest ally over hypothetical future trade relationships. And China? Tariffs range from 25% to 60% depending on the sector, with threats to go to 100% on semiconductors and rare earth minerals. Now here's why this matters for gold. The US dollar has dropped 12% on a trade-weighted basis since November 2025. When the dollar weakens, gold, which is priced in dollars, becomes more attractive to foreign buyers. But there's something even more important happening here. The EU Commission president called Trump's tactics economic blackmail. Central banks around the world are watching the US weaponize the dollar through tariffs and sanctions, and they're asking themselves a terrifying question. Can we trust holding our national wealth in dollars when America might freeze our assets tomorrow? This brings us to what's really driving gold prices higher, the Sell America movement. International investors are reducing exposure to US assets at the fastest pace since 2008. Where's that money going? Into gold, real estate in safe jurisdictions, and alternative currencies. Currency strategists at major banks are now openly discussing scenarios where the dollar loses its status as the world's primary reserve currency within 10 to 15 years. Just 2 years ago, that would have been dismissed as conspiracy theory nonsense. Today, it's being modeled by JP Morgan and Goldman Sachs. In a world without dollar dominance, gold doesn't just hedge currency risk. It becomes the neutral reserve asset that every nation can hold without political vulnerability. The second catalyst is even more disturbing, and it strikes at the heart of American financial credibility. The Federal Reserve, arguably the most powerful financial institution on earth, is facing a criminal investigation of its chairman. Let that sink in. The Justice Department is investigating Fed Chair Jerome Powell over testimony about a building renovation project. On the surface, it's about a $2.5 billion headquarters cost overrun. But everyone in financial markets knows what this really is: political pressure on a central bank chair who won't cave to demands for aggressive rate cuts. Trump has been explicit. He's posted on social media demanding zero interest rates now and threatening to make changes at the Fed. Here's why this matters. The Fed has never, in its 111-year history, had a sitting chairman under criminal investigation by the executive branch. This crosses a line that was designed to be uncrossable. When central banks lose independence, catastrophic things happen. Look at Argentina's persistent inflation crises. Look at Turkey's currency collapse. Look at Venezuela's hyperinflation. Look at Zimbabwe's complete monetary breakdown. Every single one of those disasters involved central banks that surrendered independence to political pressure. Now, I'm not saying the United States will become Venezuela, but currency markets are repricing dollar assets to reflect increased institutional risk. And that repricing shows up as higher gold prices. Here's the technical situation. With interest rates at 3.5% and inflation running at 3.2%, real yields, the returns after inflation, are barely positive at just 0.3%. Gold thrives in low real yield environments. Why? Because when bonds pay almost nothing after inflation, the opportunity cost of holding gold disappears. JP Morgan estimates that if real yields turn negative, which they give 35% probability by Q3 2026, gold could hit $5,800 per ounce. Goldman Sachs goes even further, noting that negative real yields have historically explained 67% of gold price variation over the past 4 decades. When real yields go negative, gold goes vertical. And with political pressure mounting on the Fed to cut rates while inflation remains sticky above target, negative real yields are looking increasingly probable. The third catalyst is what keeps defense analysts awake at night: simultaneous global shocks. We're facing something risk experts say is more dangerous than any period since the Cuban Missile Crisis of 1962. Multiple conflicts across multiple continents, each with escalation potential, and all happening at the same time. Let me break this down. Ukraine. The war grinds on with no resolution in sight. Russia continues intensive drone and missile attacks on civilian infrastructure. NATO is debating direct involvement. Russia has moved tactical nuclear weapons closer to Ukraine's borders and updated its military doctrine to explicitly reference potential nuclear use if Russia faces existential threat. Think about that. We're one miscalculation away from the first nuclear conflict since 1945. Middle East. U.S.-Iran tensions have exploded following Israeli strikes on Iranian nuclear facilities. The fragile Gaza ceasefire has already seen 401 Palestinians and 23 Israelis killed since the truce began. And here's the terrifying part. According to International Atomic Energy Agency reports, Iran now possesses sufficient fissile material for 4 to 5 nuclear weapons if it chooses weaponization. Israeli officials have stated, on the record, that they view a nuclear Iran as an existential threat requiring military action. That sets up a confrontation timeline that could trigger regional war within months, and 21% of global petroleum flows through the Strait of Hormuz. One significant disruption could spike oil prices overnight, triggering inflation that cascades through the entire global economy. Venezuela? U.S. Special Operations Forces captured President Maduro in December 2025, creating a power vacuum that military loyalists, opposition parties, and narcotics trafficking organizations are now fighting to fill. Venezuela produces 800,000 barrels of oil per day that global markets can't easily replace. Cuba, Russia, and China have all condemned the action and hinted at supporting resistance movements. The Organization of American States is divided down the middle. Now, here's what's truly frightening. HSBC's Global Research Division assigns 45% probability to at least one major geopolitical shock in 2026, defined as an event causing more than 10% moves in currency, commodity, or equity markets within 30 days. Goldman Sachs strategists note that geopolitical risk premiums are at their highest levels since September 11, 2001. When everything is correlated to risk-off sentiment except gold, gold becomes the only diversifier that actually works. And that's exactly what we're seeing in institutional portfolios right now. Now let's talk about something that's flying under the radar, but could be the most important factor of all. Who's buying, how much, and why they can't stop. Central banks added 45 tons of gold to reserves in November 2025 alone. For the year through November, they accumulated 297 tons, despite gold trading above $4,000 per ounce. Think about that. Central banks are buying gold at record prices. That's not speculation. That's strategic positioning. And here's the number that should make your jaw drop. 95% of central banks expect to increase their gold reserves in 2026. 95%. The World Gold Council's annual survey has never recorded such overwhelming bullish sentiment. These are conservative institutions managing trillions in reserves, and they're essentially unanimous that gold needs to be a bigger part of their holdings. Poland leads with 95 tons purchased in 2025. Kazakhstan added 49 tons. Brazil added 43 tons. But the real story is China. China has extended its buying streak to 14 consecutive months, accumulating 304 tons in reported reserves. But analysts believe the actual holdings are significantly higher. China has a history of underreporting until accumulation cycles are complete. Here's the math that changes everything. China currently holds approximately 4% of its reserves in gold. The United States holds 70%, Germany, Italy, and France hold 60% plus. If China increases its allocation to just 10%, still conservative by Western standards, it would need to purchase an additional 7,000 tons. That's equivalent to roughly 3 years of total global mine production. Let me repeat that. 3 years of global mining output. The market implications of sustained Chinese buying at that scale would be profound. We're talking about a structural bid that could push gold well beyond $6,000 even without other supportive factors. And China is being explicit about its intentions. The People's Bank of China deputy governor recently stated that over-reliance on any single currency creates systemic vulnerabilities that prudent reserve management must address. That's diplomatic language for we're getting out of dollars and gold is where we're going. But it's not just central banks. Retail and institutional investors are piling in through ETFs at a record pace. Gold ETFs recorded $89 billion in inflows in 2025, shattering the previous record of $47 billion set during the COVID panic. That $89 billion purchased approximately 530 tons of gold, equivalent to 17% of annual global mine production. The SPDR Gold Trust, ticker symbol GLD, now holds 1,073 metric tons. That's more gold than the central banks of Saudi Arabia, South Africa, or Lebanon. And the geographic breakdown is fascinating. Asian investors led November purchases at $3.2 billion. North America added $1.1 billion. Europe contributed $978 million. This is broad-based global demand. This isn't one region speculating. This is investors across continents recognizing the same risks and reaching the same conclusion. Gold is essential protection. average daily gold trading volume has surged 56% year over year to $361 billion. That's not a typo. $361 billion changing hands every single day. That kind of liquidity explosion creates a self-reinforcing cycle. More liquidity attracts larger institutional investors, which creates deeper markets, which attracts even more capital. We've crossed a threshold where gold is now viable for the largest pension funds and sovereign wealth funds in the world. That's new. And it's potentially game-changing. So where is gold actually headed? Let's look at what the smartest analysts on Wall Street are saying and the math behind their forecasts. Goldman Sachs, $5,200 year-end 2026 target. Their base case assumes continued Fed independence challenges, modest dollar weakness, and sustained central bank buying. That's roughly 2% upside from current levels, which sounds conservative until you realize they're also modeling significant volatility around that target. Citigroup, $5,600 target, premised on accelerating de-dollarization and further dollar weakness. But here's what's buried in their research. They suggest gold could reach $6,000 if geopolitical risks escalate significantly or if the Fed is forced into emergency rate cuts due to recession. JP Morgan, more conservative at $4,800, arguing current prices have discounted most risks. However, and this is crucial, they acknowledge significant upside risk if conditions worsen. That's analysts speak for, we might be way too low. Bank of America, perhaps the most nuanced view, suggesting gold trades in a wide $4,500 to $5,800 range throughout 2026. They assign 40% probability to the $5,200 to $5,800 scenario, 35% probability to $4,800 to $5,200, and 25% probability to below $4,800. Now, let me give you the scenarios that could drive prices to the high end or beyond these targets. Bull scenario: Fed loses independence credibility, tariff wars intensify, one major geopolitical shock occurs, Ukraine escalation, Iran-Israel conflict, or Middle East oil disruption. In this scenario, gold reaches $5,800 to $6,200 by year-end, probability 35–40%. Base scenario: current tensions persist without major escalation, Fed maintains some independence, central banks continue steady buying. Gold trades $5,000 to $5,400 range, probability 40–45%. Bear scenario: tariff deals emerge, geopolitical de-escalation, Fed successfully reasserts independence. Gold corrects to $4,500 to $4,800. Probability 20–25%. Here's my take. The structural factors supporting gold, de-dollarization, central bank buying, negative real yields, are so strong that even the bear scenario represents only modest downside from current levels. The risk-reward is asymmetric. If things get worse, gold could surge 15–20% or more. If things get better, gold might correct 8–12%. That's a compelling risk-reward profile, especially when you consider gold's role as portfolio insurance. Insurance that happens to be appreciating rapidly right now. From a technical perspective, gold has broken through massive resistance levels at $4,800, $5,000, and $5,100, each of which now becomes potential support. The 50-day moving average just crossed above the 200-day moving average in what technical traders call a golden cross. That's historically been a bullish signal that precedes sustained rallies. The relative strength index sits at 73, which is considered overbought territory. But here's what mainstream analysis misses. During the 2011 bull market, RSI remained elevated for months while gold climbed from 1,400 to 1,900. Overbought can stay overbought in powerful trends. And this is a powerful trend. MACD indicators show strong bullish momentum with positive histogram bars expanding. Every momentum metric is pointing higher. Now, there is caution warranted. The distance between current prices and the 50-day moving average is 8.4%, larger than the historical average of 3–4%. This suggests prices have run ahead of trend and might need consolidation. Bollinger Bands show gold at the upper band, which often precedes short-term pullbacks even within longer-term bull markets. Translation: expect volatility, expect pullbacks. But the underlying trend appears firmly intact. So what should you do with this information? First, let's be crystal clear about something. I'm not a financial advisor, and this isn't financial advice. You need to make your own decisions based on your personal situation, risk tolerance, and financial goals. But I can tell you what financial advisors are generally recommending to their clients right now. Traditional guidance suggests 5 to 15% gold allocation for balanced portfolios, with higher allocations during periods of elevated uncertainty. Given current conditions, many advisors are recommending the higher end of that range. Gold allocations make particular sense if you have significant dollar-denominated assets vulnerable to currency depreciation, concentrated exposure to assets that correlate with geopolitical stability, income needs requiring inflation protection, retirees. This is especially relevant for you, tax-advantaged accounts where gold's lack of income generation matters less. Gold doesn't generate dividends or interest. Its value comes from scarcity, safe haven demand, and its role as a currency hedge. That means short-term volatility is inevitable. But here's what history shows. Gold's diversification benefits are most valuable precisely during periods of stress, when traditional asset correlations break down and portfolios need ballast. The academic research from Harvard, MIT, and the London Business School is clear. Portfolios including 5 to 15% gold allocations have historically achieved better risk-adjusted returns than portfolios limited to stocks and bonds. This isn't speculation. This is risk management. And right now, the risks being managed are substantial and growing. Now, before we close, I need to give you the balanced perspective, because there are risks to the bull case. Gold's rapid 70% ascent has created vulnerability to profit-taking. If the Fed successfully asserts independence, if tariff negotiations produce breakthrough agreements, or if major geopolitical conflicts suddenly de-escalate, gold could face significant selling pressure. Sentiment surveys show 87% of precious metals analysts are bullish on gold's near-term prospects. Historically, when everyone agrees on a trade, that's often a contrarian indicator. Extreme consensus can precede corrections. Gold's price-to-production cost ratio now sits at 2.7x, well above the long-term average of 1.8 2.0x. This suggests prices have outpaced fundamental supply-demand equilibrium, at least by traditional metrics. And let's be honest, nobody knows the future. Unexpected positive developments could trigger sharp sell-offs. Central banks could slow their buying. Geopolitical tensions could ease faster than expected. The point isn't that gold only goes up. The point is that the structural case for gold exposure right now appears compelling when you weigh the probabilities and potential outcomes. You should never invest money in gold or anything else that you can't afford to lose or that you'll need in the short term. Gold should be viewed as long-term wealth preservation and portfolio insurance, not a get-rich-quick scheme. That said, the insurance is appreciating rapidly right now. And that combination, protection that's also generating returns, is rare and potentially valuable. Here's what I want you to understand. We're witnessing a genuine monetary inflection point. This isn't just a rally. This is a fundamental shift in how global investors, governments, and institutions view wealth preservation in an increasingly multipolar and uncertain world. Gold's breach of $5,000 per ounce might ultimately be remembered not as a bubble peak, but as the beginning of a longer revaluation, reflecting gold's enduring role in a world where trust in institutions proves fleeting, but trust in scarce, tangible assets remains eternal. Central banks managing trillions in reserves are buying gold despite record prices. Institutional investors bound by fiduciary duty are adding gold despite its lack of yield. Retail investors across cultures and continents are allocating savings to gold despite thousands of alternative investments. This universal behavior across diverse actors with different incentives suggests a shared recognition. Traditional financial assets face risks that gold can uniquely hedge. The convergence of trade wars, monetary policy uncertainty, de-dollarization trends, and geopolitical instability creates conditions where gold's unique properties, physical scarcity, political neutrality, no counterparty risk, 5,000-year track record become increasingly valuable. Now, I've given you the data. I've shown you the institutional analysis. I've presented both the bull case and the bear case. What you do with this information is entirely up to you. But one thing is certain, ignoring what's happening in precious metals right now because gold seems expensive might be one of the costliest mistakes investors make in this decade. If you found this analysis valuable, I need you to do 3 things right now. First, hit that subscribe button and turn on notifications. We're living through a period of unprecedented financial volatility, and I'm tracking every development that matters to your wealth. You don't want to miss what's coming next. Second, drop a comment below. Tell me, do you think gold hit $6,000 in 2026? Are you buying at these levels, waiting for a pullback, or sitting this out entirely? And what concerns you most? Tariff wars, Fed independence, or geopolitical risks? I read every comment and I'll respond to as many as I can. Third, share this video. I guarantee you have friends, family members, and colleagues who have no idea what's really happening with gold right now. They're hearing headlines about $5,000 gold, but they don't understand the why behind the move. Send them this video. It might be one of the most valuable things you share with them this year. And if you want to go deeper, I've compiled a comprehensive resource document with all the institutional research, technical analysis, and portfolio allocation strategies discussed in this video. The link is in the description. It's free, and it includes sources from Goldman Sachs, JP Morgan, Citigroup, the World Gold Council, and more. Knowledge is power, but only if you act on it. Don't be the investor who understands what's happening, but fails to position accordingly. Remember, in a world where currencies are weapons, institutions are compromised, and geopolitical conflicts multiply, the oldest form of money is becoming the newest safe haven. Gold isn't just breaking records, it's reclaiming its throne. The question isn't whether you can afford to own gold at $5,000. The question is whether you can afford not to. I'll see you in the next video. Stay sharp, stay informed, and stay ahead.